there is just one account that we need to make sure that clients have if they're thinking about retiring before age 60. And the reason why that is because there's a 10% penalty for withdrawals from IRAs and 401ks if you're under that magic age of 59 and a half. But there are exceptions to that penalty, and it allows people to take money out without paying the 10% penalty. And some of the exceptions apply only to IRAs, and some apply only to 401k. So it's important to know the rules for both of those before you actually retire and start implementing that income plan that you planned for. So in this video, I'll share the exceptions so you don't get stuck paying that extra 10% penalty to the government if you're retiring before age 60. But before I do, I'm Dave Zoller, and I've been helping people retire for over 13 years, and I run a retirement planning firm called Streamline Financial with Tim and Luke and Sean, and we help a select number of clients here, and we created this channel to help those who are not clients. So if you like helpful, practical retirement tips, be sure to subscribe so that you don't miss the next one on making your retirement better. Also, there are some helpful resources down below this video for retirees. So first, let's get into the exception for the 10% penalty for IRAs only. And just as a reminder, before making any decisions with finances, always be sure to just talk to your financial professionals so that you make sure you're not missing anything when implementing these things. So the first exception for IRAs only is buying health insurance if you lost your job and you collect unemployment for at least 12 consecutive weeks. And then I'll go through these pretty quickly. The next exception is paying for higher education expenses, either for yourself or for your kids. It also works for grandkids as well. The third probably doesn't apply to you, but it's that you can withdraw up to $10,000 from your IRAs for a down payment on the first time purchase of a house, or first time home buyer purchase. Next is the exceptions to the 10% penalty for 401ks and similar plans like 403bs or a few other qualified retirement plans. So this is just 401ks and those types, not IRAs. Now, there are about 5 or so exceptions here, but there's really one that really matters, and it may be applicable to you and your retirement plan. So I'll share it, and then I'll share a mistake that sometimes people make when they're planning retirement. And that most applicable one is the rule of 55. And the rule of 55 is, it's an IRS guideline that allows you to avoid paying the 10% penalty or early withdrawal penalty on 401ks and 403b retirement accounts if you leave your job during or after the calendar year you turn 55. And the rule applies regardless of the terms of your separation. So you can either take advantage of it, whether you have been laid off, or if you decide to just retire early. Now, the rules with this exception are very specific, so you just want to make sure you get your finance team or make sure you talk to the plan sponsors to confirm what you're doing is correct. I've seen some plans in the past where they actually don't have this built in, this age 55 to 60 withdrawal without penalty, but you just want to make sure that it's there and that you can take advantage of it. Now, the mistake that I see people make when they're planning their retirement, they map out their retirement at age 55 and everything looks good, and they have enough in the non-retirement accounts that are not subject to tax when they take money out, and they'll use that for the first 5 years. So maybe their brokerage account or cash at the bank, things like that. Because they've got 5 years outside of retirement accounts, they'll roll over their entire 401k or their 403b to an IRA. And the problem that we sometimes see happen is if something doesn't go according to plan, they may find themselves having to draw from their IRA earlier than planned, earlier than age 59 and a half or 60. And because it's not in that 401k anymore, they would have to pay the 10% penalty to take it out of their IRA. So it might be worth not rolling over the 100% of your 401k to an IRA if you're under 59 and a half, and maybe have that little buffer in there as a second line of defense or backup plan in your 401k if you needed something else. But that's something to talk to your retirement team about to just make sure it works for you. Now, there are a few other exceptions to the 401k 10% penalty that apply to a few select people like public safety employees and government 457 plans. So I'll include a link to the full article below this one if you want to skim that. It's for a few select types of people, but feel free to take a look at that. Now, up next are a few of the exceptions that could apply either to, or really both, to the IRA or 401k. And hopefully taking the time to record this video has been helpful. If it has, please click the like button so that hopefully it could spread to other people and help them as well. So here are some of the other exceptions to IRA or 401k or 403b. It's medical expenses to the extent that they exceed 10% of your adjusted gross income. The next one comes with a warning, and it's the exception, which is substantially equal payments. That's also known as the 72T exception. And this is where you take your balance distributions over substantially equal payments. Now, it kind of sounds confusing, but being part of a CPA firm that helps over 2,000 people, I've seen quite a few times where this strategy goes wrong. And if it's done wrong, the entire balance of the account could be taxable, including that 10% penalty if you're under 59.5. So this is one that why I've got a warning or a caution. If you're looking at this one, just make sure you've got a CPA or your team evaluating all the things to make sure that it's done right. The next exception is disability, and it must meet the IRS definition of total permanent disability, and you've got to have documentation from a doctor. Now, the next one is adoptions or the birth of a child. Up to $5,000 in withdrawals can be penalty-free in that first year for the adoption year. Now, there are a few more exceptions, but these are the ones that seem to be the most common. So I just wanted to share them with you in this video. To see all of them, they're in the article below. I hope that you enjoyed the video, and I hope that I can see you in the next one as well. Take care.